Earnings season has officially started, and this is going to be a major week for the overall market. We have Tesla, Visa, Meta, Microsoft, and Alphabet all reporting their earnings this week. And as you guys know, I am going to do my absolute best to make as many earnings recap videos as I possibly can here on my channel. So if you would like to stay up to date with all of the earnings releases as they come out, then make sure to subscribe to my channel if you haven't already. Now, with that being said, in today's video, I want to discuss my thoughts on these businesses that I have outlined here before they report their earnings this week. And there's quite a bit of news that we need to discuss in regards to Tesla and Google especially. So with that being said, let's just hop right into the video. What I've been noticing is that there is a lot of negativity and bearishness around Tesla stock right now. I'm pretty active on Twitter and I try to stay up to date with all of the news going on. Full disclosure, I do not own shares of Tesla and I'm not looking to buy any shares of Tesla, but I have noticed that the sentiment towards this stock has changed massively. And now we have articles like this coming out where the headline says, Tesla's shares are officially down 40% this year. Here's why the stock could fall further. So the stock is already down 40% so far this year, and people are now putting out articles and writing that, hey, Tesla's stock could maybe even fall further. There's also been a wave of some pretty bad news coming out around Tesla. So take a look at this. Tesla recalls nearly 3,900 Cybertrucks over gas pedals that can get stuck, causing the truck to accelerate. So Tesla has had to recall nearly 4,000 Cybertrucks already. On top of the Cybertruck woes, Tesla is discounting the price of its full self-driving driver assist program to $99 a month. It was previously $199 a month or $15,000 for a one-time purchase. So it looks like full self-driving is also starting to be discounted, and this is a discount of about 50%. So I'm also seeing the bears start to push this all over Twitter and start putting this in articles as well, that full self-driving may not be nearly as profitable as investors once thought. Tesla has also cut prices of its vehicles in major markets as its sales have been falling. For Q1, Tesla reported 386,810 global vehicle deliveries, well below the estimates of basically 450,000. So Tesla's Q1 deliveries for their vehicles look like they were down pretty significantly as well, and came in well below analyst estimates. This is causing people to say that there could be a demand problem over at Tesla, especially because the company produced 433,000 vehicles in the first quarter as well. So Tesla produced roughly 50,000 more vehicles than it actually sold in Q1. And then the bears are also saying that this is why Tesla is lowering the prices of its vehicles, because now they are making more vehicles than the company can sell, or basically they have a supply problem. If we head over to Tesla's own investor presentation, we can see their historical deliveries right here on the furthest left-hand side, and I drew a red line where about 380,000 vehicle deliveries are. And we can see that their deliveries are now down over the past about 18 months. So this was one of the worst quarters for deliveries over the past almost 2 years. Now, if we take a look at what analysts are expecting for Tesla in the first quarter coming up here, they're expecting about $21 billion of revenue reported. And for the full year of 2024, they're actually projecting sales to decline by 0.5 percentage point. So basically, analysts are expecting Tesla's full year revenue this year to be flat. And this is kind of interesting to me because Tesla is still valued like it is a pretty fast growing business. I mean, its price ratios are not low by any means. Yet the business is seeing a lot of headwinds right now, and its revenue is projected to come in flat this year. So it's not really a growth company, at least at the moment. Now, additionally, if we take a look at Tesla's fourth quarter earnings results, we can see that for the fourth quarter, they generated about $21.5 billion in automotive revenues, and the fourth quarter of 2022, they generated about $21 billion as well. So year over year, their revenue only grew by 1%. However, we can see that the total company revenues grew by 3%, but its gross profits were down 23%. So Tesla's profit margins are actually dropping right now. And again, even in the fourth quarter for 2023, the company's revenue wasn't really growing. So it very much so seems like the business's revenue is flat and topping out right now. Now, if we head over to Stock Unlock, we can also see this on Tesla's income statement if we take a look at the quarterly view. So the revenue was growing incredibly well, right? And then it kind of stopped growing significantly right here in about the third quarter of 2022. And if we take a look at a trailing 12 months view now, it looks like the revenue is definitely slowing down. Now, at the same time, Tesla's operating income is starting to drop as well. And this is because the company's profit margins are actually declining, even though sales are still growing slightly and at least remaining flat. Now, the last thing that I want to do here is simply look at Tesla's price to operating cash flow, because the business is investing a lot of money still into growth. And when we do, we can see that Tesla's price to operating cash flow is still sitting at around 35, which is pretty high still, in my opinion, again, for a business that is seeing so many headwinds and is seeing its revenue not really growing anymore. To put this in perspective, Apple is a business where its revenue is not really growing right now either, but its price to operating cash flow is at 22, which is pretty significantly lower than Tesla's. And honestly, Apple's price to operating cash flow of 22 is still on the high end, in my opinion. So this kind of just puts it into perspective for how expensive Tesla stock still is. And in my opinion, Tesla stock is still pricing in a lot of future growth. So if their Q1 results are not very good, or if they miss analyst estimates once again, then the stock could probably see some more weakness. Because honestly, guys, I do not think that Tesla is a very cheap stock today. When we look at its growth that it's going through right now, its profitability, its margins dropping, and overall just the price to its actual profits, which is what investors should be valuing the business based off of. So yes, Tesla may have an amazing future ahead of it with full self-driving, with robots coming out over the next who knows how long. But with these high price ratios, again, I do believe investors are already paying for those future products and those future growth today. So personally, I'm going to not be really interested in buying Tesla stock. It's actually not a stock that I don't really know where I would buy it. I'm not really interested in owning it at all. But I do still think that it is looking like an expensive stock today. All right, but now let's move on to the next stock, which is Visa. And this stock is actually still selling right near its all-time highs. It's in a slight dip of about 6% from its all-time highs, but it's still up to $272 a share today. Now, Visa is one of the most fundamentally sound businesses I have ever seen. And honestly, I probably should have bought this stock a very long time ago, because take a look at its profitability metrics right here. On Stock Unlock, it has a perfect 5.0 profitability score, 80% gross margin, 67% operating margin, 53% net margin, and 57% free cash flow margin. So on every dollar of revenue that this business generates, 57 cents is total free cash flow for the business. That is just incredible. And I think that this is actually one of the most profitable businesses that I have ever seen. Now, if we head over to Visa's income statement, we can see that its revenue is still growing very strong and hitting all-time highs. Now, if we head over to the operating income, we can also see that it is hitting all-time highs as well and growing with the revenue. So Visa's profit margins are remaining intact, and it looks like they are remaining consistent. Now, if we also take a look at Visa's operating cash flow, it is sitting at about $20 billion now, and it is sitting right near all-time highs. So the business's fundamentals are hitting all-time highs, revenue is still growing, operating income is growing, operating cash flow is growing, and it is an incredibly profitable business. Additionally, Visa is expecting high single-digit to low double-digit revenue growth for the year of 2024. So they are projecting their revenue to continue growing around 10% again this year. Now, in terms of earnings per share, they are expecting EPS to grow in the high teens. This is probably because the business is projecting to buy back a lot of stock over the next year, which is going to cause EPS to grow at a faster rate than the overall revenue. So it looks like Visa is still projecting another pretty strong year in 2024. Now, the question then is, how is this business being valued today? And is it looking like it is cheap or expensive heading into its earnings? The metric that I'm going to use here is the price to operating income. And the reason for this is because if we take a look at the price to operating cash flow versus the price to operating income, the price to operating cash flow has these random spikes right here that I do think are not a true reflection of the overall business's profitability. And I think that this can kind of skew the overall metric. So again, for Visa, I am preferring the price to operating income metric right now. And currently we can see that it is trading for a price to operating income of about 24, and its 10-year average has been about 23. So Visa is trading slightly above its 10-year average price ratios, but just slightly. So in my opinion, if Visa can continue to grow and meet its projections of 10% revenue growth this year and high teen EPS growth, then the business doesn't look overly expensive, and it could be selling for arguably around fair value today. So if Visa comes out and meets analyst estimates for this quarter, then I don't really see the stock having any weakness, and this is one of those businesses that is just super high quality, and I don't really think, again, that the stock is going to see any material weakness or surprises after it reports its earnings. Visa also reports some pretty interesting credit card data with their earnings that I will be taking a look at on the channel here after they do report. All right, let's move on to the third stock in this video, which is Meta. Now, Meta honestly has massively outperformed all of my expectations. For those of you who have been watching my channel for some time, you know that I was buying Meta down when it was seeing this absolute collapse in the market. And during this time, it had a free cash flow yield of over 10%, and it was trading for a price to free cash flow of 9, which I thought was just ridiculously cheap. Then, as we all know, the stock recovered massively, and unfortunately, I did sell my shares for a pretty nice gain, what looks like pretty early or too early when we use hindsight. Now, as I explained on my channel, the reason that I sold my shares what seems like pretty early is because one, Meta was never really a stock that I wanted to own over the long term. I simply bought it because I thought that it was looking way too cheap to ignore. So when the stock got up to what I believed was fair value, I let go of it and I locked in over 100% gains in a very short amount of time. And I thought that was a really good win. And the second reason I sold my Meta shares is because I was not expecting this business to see 20% year over year revenue growth anytime soon. But Meta, again, has been outperforming all of my own expectations. And that kind of shows you that I'm not really someone who can accurately predict the future of this business, which could also be an argument that maybe it shouldn't be in my own portfolio because I massively underestimated it. So if we take a look at Meta's fourth quarter earnings results, which was its most recent earnings results, we can see that they did $40 billion in revenue. And you can clearly see how strong this quarter was. And I was not expecting this. Outside of Nvidia, I think that Meta had the best earnings results for the fourth quarter of 2023, and it blew the market and myself out of the water. If we take a look at a trailing 12 months view, we can also see that Meta's revenue is starting to re-accelerate, which is a great thing to see for the business. Its operating income is also back to all-time highs and massively growing. And if we take a look at its operating cash flows are also at all-time highs now, sitting at $71 billion and growing pretty nicely as well. So I do think that this rebound in Meta stock was completely justified. So now the question is the stock still looking cheap today or expensive heading into its earnings? And how do I think the market will react? Well, the CFO of Meta gave us the Q1 2024 projections. And here they say, we expect first quarter 2024 total revenue to be in the range of $34.5 billion to $37 billion. So the middle of the range there is around $35.5 billion in revenue for the first quarter of 2024. Surprisingly, this means that if Meta does hit this target, then that will be another quarter of 25% year over year revenue growth, which is just insane. Meta just continues to kill it. So now if we take a look at Meta's price to free cash flow, we can see that it is basically sitting at 28 today, and its historical average over the past about 8 years has been around 28.7. So Meta, surprisingly, is selling slightly below its 8-year average price to free cash flow. And if the business can continue to grow its revenue at 20% annually, then honestly, this price ratio does not look that expensive. Again, my problem is simply that I don't have the conviction or the knowledge to know if Meta is going to continue compounding its revenue at 20% from here, or if it is currently seeing a pretty strong lift to its revenue, and then maybe next year revenue flatlines again at 3%. This is one of those businesses where personally I find it pretty challenging to predict, and that is why I am not as confident in the price today, and I don't have that conviction to buy the stock at its current price ratio. But there is an argument that Meta is not very expensive right now. Again, it is trading below its 8-year average price to free cash flow ratio, and it is still growing its revenue by 20%, at least at the moment. It's not nearly as cheap as it was down here in November of 2022 when it was trading for a price to free cash flow of 9. But again, there is still an argument that maybe Meta stock is looking cheap today. So in my opinion, what it really comes down to for this Q1 earnings report for Meta coming up here is if the business can meet those targets that it set when it reported its fourth quarter 2023 results. Is it actually going to report $35 billion in revenue, or is it going to come in below that? I think the market is basically pricing the stock based on what it was projecting for the fourth quarter of 2024. So again, if Meta's reported revenue comes in below that, then I do think the stock could see weakness. But if it meets those targets, then I think the stock is going to remain holding up fine and, again, probably just remain where it is. All right, now the next stock that we have to talk about is Microsoft. Now, Microsoft stock is slightly below its all-time highs here. It's in a dip of about 7% right now. Nothing major, but the stock is in a little bit of a dip. Now, if we take a look at Microsoft's financials, this business has been growing incredibly well. Here we can see that its revenue is continuing to grow. It's at all-time highs, and it is looking like it is re-accelerating a little bit. Now, if we also take a look at the operating income rate here, it is also re-accelerating, and it is sitting at an all-time high as well. Now, cash flows, if we take a look at operating cash flows, this is the exact same story. Cash flows are at a record high of $102.6 billion now, and it is clearly still uptrending. Now here we can see that analysts are expecting about $57 billion in revenue for Microsoft in the first quarter of 2024 coming up here. This is 7% year over year growth to revenue for the first quarter. Now here we can also see that for the year of 2024, analysts are expecting Microsoft to grow revenue by about 8%. So these are still decent growth rates, but they're not like incredible growth rates at all, right? I mean, 8% revenue growth for the year is nothing really eye-shattering or anything like that. It's not like Meta growing its revenue at 20%. Now, here is my concern with Microsoft stock. It's simply selling for a price to free cash flow of 44 right now. This is an extremely high price ratio for a business that is growing its revenue at 8% per year. Now, what I think happened with Microsoft stock is I think investors know that Microsoft's business is obviously going to grow over the long term. Like, as an investor in the market and someone who pays attention to the markets, it is pretty obvious that Microsoft's business is going to be larger than it is today in 5 years. However, the thing that can happen in the stock market is you can end up paying too high a price for a business, which ultimately means that you are paying for its future growth already today. Therefore, even if Microsoft's business does end up growing in the future, if you pay too high of a price for it today, then you've already paid for all that future growth and your future returns can be low or negative. So in my opinion, I do believe that investors are already paying for a significant amount of Microsoft's future growth. Again, this is a 44 price multiple on a business that's growing its revenue by about 8% today. That is extremely high, and in my opinion, Microsoft is actually overvalued today. For example, its 10-year average price to free cash flow has been about 27, so it is selling significantly above its historical average price ratios. And even just on a total basis, 44 times cash flow is expensive for really any stock. This is typically the price ratio that I see on businesses that are growing their revenues between 30 and 50%. So I don't know. To me, there's just a little bit of a mismatch with Microsoft's price today versus how quickly the business is actually growing, which ultimately leads me to the conclusion that I think Microsoft stock could produce low or negative returns over the next 3 to 5 years. Because again, I do think that investors are already paying for that future growth. Now, in terms of Microsoft's Q1 earnings report coming up, I don't think that there's going to really be any surprises here, so I don't really anticipate the stock falling massively or anything like that. And I think that analysts are probably pretty accurate with what they're expecting for Microsoft's business to produce. So it's probably already priced in based on what the market thinks and based on how expensive the stock already is, based on how much investors love this stock right now. So yeah, personally, I'm just not really seeing any surprises for Microsoft stock in this Q1 earnings release. All right, now moving on to the fifth and final stock that we got to talk about in this video, which is Google. This is one of the Magnificent 7 stocks that I actually own today, still in my portfolio. There's also been some really interesting news coming out with Google that we are going to quickly discuss in this video as well. So first off, let's take a look at Google's financials here really quickly, and let's take a look at its income statement. And we can see that revenue is at an all-time high for Google, and it looks like it is starting to re-accelerate a little bit there. Now, if we take a look at Google's operating income, this is the exact same story. Operating income is at an all-time high and hitting about $88 billion now. If we move on to the cash flow statement, we can see that operating cash flows are now at about $101 billion and sitting right near all-time highs as well. So Google's fundamentals look like they are strong, the business is continuing to grow, and all of its key metrics are sitting at all-time highs right now. Now here we can see that for the first quarter of 2024, analysts are expecting about $74 billion in revenue, which is growth of about 5.6% year over year. However, for the full year of 2024, analysts are expecting Google to grow its revenue by about 11.4%. So this quarter looks like it could be a slower quarter for revenue growth, but for the full year, analysts are still expecting over 10% revenue growth for Google, which is an overall good thing in my opinion. Now moving on to the recent interesting news that came out from Google. There was this one Twitter account, Gurgavin, who is great to follow, by the way, for breaking news. And this says, just in, a group of Google Cloud employees have forcefully entered the CEO's office and have threatened to stay there until Google cancels its $1.2 billion contract with the Israel government. So employees over at Google basically stormed the CEO's office and higher management's offices and said, we are not going to leave until we cancel this $1.2 billion contract with the Israeli government. I don't really want to get into that conversation too much here on my channel, but this is just really interesting to see that this happened over at Google. Now, what's even more interesting to me is the CEO, Sundar's response to this event. So here this says, you may have seen reports of the protests at some of our offices yesterday. Unfortunately, a number of employees brought the event into our buildings in New York and Sunnyvale. They took over office spaces, defaced our property, and physically impeded the work of other Googlers. Their behavior was unacceptable, extremely disruptive, and made coworkers feel threatened. We placed employees involved under investigation and cut their access to our systems. Those who refused to leave were arrested by law enforcement and removed from our offices. Following the investigation, today we terminated the employment of 28 employees found to be involved. Behavior like this has no place in our workplace, and we will not tolerate it. We are a place of business, and every Googler is expected to read our policies and apply them to how they conduct themselves and communicate in our workplace. If you're one of the few who are tempted to think we're going to overlook conduct that violates our policies, think again. The company takes this extremely seriously, and we will continue to apply our long-standing policies to take action against disruptive behavior, up to and including termination. So this to me was pretty surprising because it's been becoming known that Google kind of has a culture problem. Their culture just seems to be not really work related or work focused anymore, and the culture seems to be heavily focused on politics. Now, why I like what Sundar did here is because this is kind of bringing Google's culture slowly back into focusing on work and actually being a business again. These protesters were motivated entirely based on politics, and they tried to shut down a $1.2 billion contract based on their political views. Now, the CEO is saying, no, we're not going to tolerate this behavior anymore, and we are going to fire you if you are disrupting our business and trying to do things like this. So I actually do hope that this continues and that Google gets its culture back on track, because I do think the company really needs that to happen. Now, additionally, on April 17th, Google announced that it was laying off more employees and shifting some roles abroad to try and cut some costs. Now, if you watched my Bill Ackman video recently, then you know that Google is currently trying to increase its efficiency and kind of go through its own year of efficiency and get its profit margins back up. Now, personally, I do believe that Google can get its profit margins back up, get its free cash flow margins up quite significantly. So this is just kind of the company continuing to execute on being more efficient. Google is also one of the companies that still has an oversupply of employees, it seems, because they did a massive hiring spree during COVID, and now they're kind of trying to fix that still. Meta already seems like it has fixed its overhiring problem, but Google still seems like it needs to go through a little bit of a layoffs to right that ship. All right, so now let's take a look at Google's price to free cash flow right here. And it is currently sitting at 27.7, which is actually below its 10-year average of 28.8. So Google is selling slightly below its 10-year average price to free cash flow right now, which could suggest that the business, just like Meta, is arguably selling below fair value or right near fair value. Now, again, Google is projecting about 10% revenue growth for this year. And honestly, in my opinion, I do think that, yes, Google is selling below its historical average price to free cash flow ratios, but a 27 price to free cash flow for 10% revenue growth, I do think is still on the higher end. And what I've been noticing in the market, especially recently, is the top stocks in the market like Apple, Microsoft, Google, Meta, and Nvidia, Tesla, these kinds of businesses, they just get high price ratios no matter what, because I think that the market and investors are so focused on them. Like, you're not really going to have an edge saying, hey, I'm buying Google right now, because every single investor knows about Google and probably has Google already in their portfolio. So basically what I'm trying to say is these businesses just kind of seem to have overall premiums on them all the time, no matter what. Well, I shouldn't say all the time, because when Meta was selling for a price to free cash flow of 9, there was no premium on the business. Also, when Google was selling for a price to free cash flow of 18 in 2022, I don't think that there was a premium on the business. But in general, when we take a look at the 10-year average price ratio here, I do think that there is kind of just like an overall premium on these businesses on average, okay? And the reason I think this is because I have a lot of stocks in my own portfolio that have significantly lower price ratios that are also projected to see 15 to 20% growth over the long term. So what I have done in my own portfolios, and I will be doing a portfolio update later on this week, but what I have been doing in my own portfolios is I've noticed I've been concentrating more on these businesses that are selling for lower prices and seeing higher growth than the Magnificent Seven stocks like Google, etc. So even though I do still own Google in my portfolio and I'm not looking to sell it, it's just not a stock that I am actively adding to at its current price or really looking to add more to at its current price. Because again, I am finding stocks with lower price ratios and higher projected future growth. So that is what I am focusing on in my portfolio. And if you would like to stay up to date with everything I am buying and selling in my portfolios in real time, then you can go and join my Patreon. And over in my Patreon, I make posts when I buy stocks, when I sell stocks, and I also do portfolio updates and give my Patreon members my thoughts on all of my portfolios, the breakdowns, what I'm thinking about the valuations of the stocks, etc., etc. So again, if you would like to stay up to date with everything I am buying and selling in the market and get Patreon exclusive content and extra videos from me, then again, please consider joining my Patreon, as it is also the #1 way to support my channel and my work here that I do on YouTube. But with that being said, that is going to wrap up the video, everyone. So thank you so much for tuning in, and make sure to subscribe to my channel if you want to stay updated for all the earnings updates that are going to be coming out over the next couple of weeks, because I am going to be trying to cover as many as I can. But that's going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.